Hi, my name is Inta Syazim binti Muhammad Nasir with matric number A193794.
Hi, my name is Kistina Wafika binti Hamidi with matric number A195292.
Hi, my name is Aisha Nohani binti Amir, number matrix A195655.
Hi, I am Haziq bin Muhammad Saleh, matrix number A195849.
Hi, my name is Muhammad Amshad bin Muhammad Rizwan. My matric number is A196215. Thank you.
Hi, my name is Fatini Zati binti Ahmad Ramzi with the matric number A196322.
Hi, my name is Muhammad Ali Fidos bin Azizul, matrix number A196374.
The four selected companies, K Alliance Group Berhad K Group, Computer Gate Berhad CompuGT, Hong Seng Consolidated Berhad Hong Seng, and BCM Alliance Berhad BC Mall, were chosen based on their distinct average weekly returns and standard deviations, reflecting a strategic mix of risk and return profiles. K Group offers a relatively high return of 0.33% but comes with the highest volatility at 0.60, making it a high-risk, high-return asset. CompuGT, with a low return of 0.03% and the lowest volatility of 0.28, plays a conservative role by providing stability in the portfolio. Hong Seng strikes a balance with a moderate return of 0.13% and volatility of 0.31, serving as a reliable core asset. BC Mall stands out by delivering a strong return of 0.30% with a moderate level of 0.36, offering an attractive risk-adjusted return. Now, when we look at the covariance and the correlation of the four stocks, K Group, CompuGT, Hong Seng, and BC Mall, we can understand how they move in relation to each other. Covariance tells us whether two stocks move in the same direction. For example, K Group has a small positive covariance at 0.0317, and BC Mall with K Group has also a small positive covariance, which is at 0.0230, meaning they tend to go up or down together a little bit. But K Group and Hong Seng have a negative covariance at negative 0.0335, which means they often move in opposite directions. CompuGT doesn't have much connection with Hong Seng or BC Mall since their covariance values are very close to zero. On the other hand, Hong Seng and BC Mall have a stronger positive covariance at 0.0278, so they often move in the same direction. Correlation helps us understand how strong those relationships are using values between -1 and 1. K Group and Hong Seng have a weak negative correlation at negative 0.1774, which supports what we saw in the covariance. Hong Seng and BC Mall have the strongest correlation at 0.2477, showing they have a moderate connection, and the rest of the stock pairs have very weak or no clear correlation. This is important for diversification if you combine stocks that don't move the same way, like K Group and Hong Seng. Your overall risk goes down because when one stock drops, another might rise or stay steady. And that's how we can build a more balanced and also safer portfolio.
For optimization process, we use Excel solver to construct the optimal risky portfolio. The goal is to allocate weights to different assets such that we achieve the best trade-off between risk and return. We focus on finding the optimal risky portfolio, which lies on the efficient frontier. This represents the set of portfolio offering the highest expected return for a given level of risk. Our objective is to maximize the Sharpe ratio, which is the most common way to measure a portfolio's risk-adjusted return. By maximizing this ratio means we want the highest return per unit of risk. Before using solver, we need to prepare data such as risk premium for each stock, initial weights for each stock which will be optimized, covariance, standard deviation, and also Sharpe ratio. Here's how we use solver step by step. So first, we set the objective to maximize the cell containing the Sharpe ratio, and then we set the variable cell to the cell containing the weights for each stock in the portfolio. And for the constraint, we set the sum of weight equals to 1 to ensure the full investment is allocated and prevent short selling. After solving using the Excel solver, we get that the higher value of Sharpe ratio is 9.1782. Alternatively, we could set the objective to minimize the portfolio variance for a given level of return, but in our analysis, we choose to maximize the Sharpe ratio. How this lead to an efficient portfolio? So by maximizing the Sharpe ratio, we are selecting the portfolio with the best risk-adjusted return and the portfolio lies on the efficient frontier, meaning no other portfolio offers a higher return for the same level of risk. This portfolio is considered efficient because it is mathematically optimized to deliver maximum performance based on historical data.
I will be presenting the optimal risky portfolio that we have derived, focusing on the asset distribution, risk-return trade-off, and the efficiency indicated by the Sharpe ratio. In this optimal risky portfolio, we have selected 4 risky assets, which is K Group, Compagity, Hong Seng, and BC Mall, with the following distribution of weight. First is K Group, which is 14%. Despite its high return, K Group has a high volatility, so it's given a lower weight to control the overall portfolio risk. For Compagity, is 24%. With its low return but very low volatility, Compagity is included to stabilize the portfolio. Next, Hong Seng is equal to 31%, offering a balanced return and moderate risk. Hong Seng is a strong core holding in the portfolio. Lastly, BC Mall equals to 31%. BC Mall offers a high return with manageable risk, making it the most efficient contributor to the overall portfolio performance. The optimal portfolio has been evaluated using several key metrics, which highlight its efficiency and performance. Risk premium equal to 0.1842. This represents the expected return of the portfolio above the risk-free rate. A higher risk premium indicates that the portfolio is expected to generate a good return for the level of risk taken. Next is standard deviation, which is equal to 0.0201. This is the measure of weekly volatility or the overall risk of the portfolio. With a relatively low standard deviation, the portfolio achieved a high return without exposing investors to extreme risks. For Sharpe ratio equal to 9.1782, the Sharpe ratio is a key indicator of the risk-adjusted return, and in this case, it is extremely high. This indicates that the portfolio is very efficient in converting risk into return, meaning it provides excellent returns for the level of risk taken. A higher Sharpe ratio suggests that the portfolio performs well in terms of both returns and volatility. In summary, this optimal risky portfolio represents the best trade-off between risk and return, with a high Sharpe ratio confirming its efficiency. The portfolio is carefully diversified across 4 assets, with specific weights chosen to combine diversified source of return while keeping the overall risk low. This approach maximizes returns while maintaining a manageable risk level, making it an excellent choice for investors seeking a balanced and efficient investment strategy. This graph shows the efficient frontier and the capital allocation line, or CAL, using weekly data. The orange line is the efficient frontier, which represents the best combination of our 4 risky assets, which is K Group, Compagity, Hong Seng, and BC Mall, that offer the highest expected return for each level of risk. The grey line represents the CAL, starting from the weekly risk-free rate, which we calculated by converting the annual government yield of 3.18% into a weekly rate. This line represents all possible combinations of the risk-free asset and the optimal risky portfolio. The point where the CAL touches the efficient frontier is the optimal risky portfolio, which is when the risk premium equals to 0.1842, offering the highest Sharpe ratio, which is 9.1782, or the best trade-off between risk and return. Investors should aim to invest along the CAL, as it allows them to achieve better returns for the same level of risk by combining the risk-free asset with the risky portfolio.
So now, let's look at the 3 types of investors which are differentiated on their approach on a portfolio and how they value and how they view their risk. So there are 3 types. So the first one is risk-averse investor, The second one is risk neutral investor, and lastly, risk seeker investor. So for the first one, a risk averse investor prefers to minimize risk, even if it means accepting lower potential returns. So in our case, this investor has a risk aversion level of 5, which is relatively high. As a result, they only invest 50% in the proportion in risky portfolio, so the remaining 50% will go into the risk-free investments such as government bonds. So, with this cautious strategy, the expected return of the complete portfolio is relatively lower than the other types of investors, which is only 9.3%, and the risk or standard deviation is 5.9%. So, this lower return, although it is acceptable because it comes with a lower risk, which aligns with their strong preferences for stability. So, in terms of asset allocation, as we can see in the pie chart, 50% will go to risk-free assets such as government bonds, and the remaining 50% will be diversified across the four shares. So for K Group is 7%, CompuGT is 11.8%, Hong Seng is around 15.4%, and BC Mall receives the highest, which is 15.7%. So these small diversified allocations reflect the investor's desire to spread risk and to avoid overexposure to any single asset.
Risk-natural investor is investor that finds the level of risk irrelevant and considers only the expected return of risk prospect. Risk-natural investor allocate their 100% fund into risky portfolio. Since risk aversion is zero and no money were invested in risk-free assets, this means that risk-natural investors choose to maximize their risk exposure for higher expected return. All the expected return come from risky portfolio, which is for risk natural investor will achieve 18.48% on complete portfolio return, and the portfolio standard deviation is 11.77%. Why actually this strategy fits risk natural investor? Because risk natural investor only focusing on maximizing their returns and not their volatility.
Now, we look at risk seeker investor, which is a type of investor who is willing to accept lower expected returns on prospect with higher amount of risk. So, in our analysis, this investor has a risk aversion score of -5, which indicates a strong preference for risky assets. As a result, they allocate about 300% of their wealth or triple the amount of investment into the risky portfolio, which implies leveraging or borrowing to increase exposure. So, here's how the complete portfolio looks for the risk seeker. The first one, the expected return or the complete portfolio return is 55.3%. The complete portfolio risk or the standard deviation 35.3%. And lastly, the utility score 86.5%. This investor chases high returns and is comfortable with significant fluctuations in portfolio value. Now, looking at the asset allocation in the pie chart, we can see that BC Mall takes the highest share at 94.3%, followed by Hong Seng at 92.7%, CompuGT at 70.8%, and lastly, K Group at 42.2%. Notice that each amount of share is tripled. This diversified yet aggressive approach shows a preference for high-performing assets regardless of risk. The overall strategy aligns with someone who is optimistic about market gains and is not afraid of volatility. Lastly, take a look at this graph. This graph compares the utility of risk seeker and risk averse investors as their proportion in the risky portfolio denoted by Y increases. As seen in the yellow line, risk seekers experience steadily increasing utility with higher exposure to risk, highlighting their preference for high risk, high return investment. In contrast, the blue line shows that risk averse investors reach a peak utility around Y is equal to 3, after which utility declines, reflecting their discomfort with excessive risk. This clearly illustrates how investor preference affect portfolio choices and satisfaction. So, to summarize, we use historical data to create an optimized portfolio tailored to investor preference. Diversification helped reduce overall risk, while Asset Solver identified the most efficient combination of assets. The optimal risky portfolio consists of approximately 14% K Group, 24% CompuGT, 31% Hong Seng, and 31% BC Mall. Different investors require different portfolio blends based on their risk tolerance, and understanding risk aversion is the key to constructing a complete portfolio that matches their goal. So that's all from us. Thank you.